We are live to go.
Let's rock and roll.
All right, Sean, throw her up.
Yep.
All right, guys, welcome to this month's investment committee. It is Tuesday, May 21st, and we got the whole team on here to talk a little bit about what's going on in the market. There's a couple of interesting things that have transpired over the month, and we also have a special guest today, Constantina Koulosousas, aka Deana. Deana is our one of our go-to estate planning attorneys. She really helps with helps clients to get their documentation in order, get their planning in order, and we work directly with her to make sure that that happens. So we've worked with her. She's going to be a great guest. She's got a lot of great information. I don't want to steal any of her thunder, so I'm going to let her kind of go into her own detail when we are through the monthly update. But go ahead, click it through, Sean.
Yeah.
But then when we're done with talking with Deana, we're gonna shoot over to a Q&A and leave an open format so that this way anybody who has some questions can chime in and shoot us a message. Alternatively, you can always reach out to us directly if you don't want your question broadcasted to the group. So we will broadcast those questions without any names, but if you just feel a little bit more comfortable having a one-to-one, then that works for us as well.
Yep. All right, so we want to jump right into an overview of the market vitals so far in 2024.
You didn't correct the percentage.
I'm just going to say, it's so far we're up about 12%, S&P 500 so far in 2024. If we look at just the last month, it's up 6.3% after a very weak April. So this goes into our kind of buy the dip strategy. After we saw a weak April, we were shifting funds from money market into equity to kind of take advantage of that dip, since we believe we're in the middle of a cycle right now. If we look at some of the other prominent indices, the S&P and the NASDAQ continue to really lead the way, up about 12% apiece. When we start to look at the Russell 2000, which is comprised of a lot of small cap companies, only up about 4.7%. Wall Street really believed that was going to outperform this year. Just has not happened yet. And if we look at international funds, also positive, not bad returns at about 7.7%. But those large cap companies in the US, those large cap technology companies specifically, have done a great job so far. Is there anything you guys want to add to that on what you're seeing so far in the markets in 2024?
Do you want to add a little color as to why we're still continuing an upward trend?
Yeah, so earnings so far have been really pushing the equity market forward. And as we've been talking to new clients, it's really been a two-sided story. So we're seeing a ton of green on the page right now. On the equity side of things, it's been those earnings. Companies are continuing to do really well. International countries are continuing to invest in the US market consistently. So that influx of dollars has really pushed the US dollar up. It's pushed that equity market up. But we can also see this 10-year treasury rate, the cost of leveraging is also up about 4.4% on the 10-year rate right now. So even though Wall Street's happy, markets are doing well, there's also that increased cost of leveraging and borrowing, which ends up kind of hurting some business owners and individuals that are really relying on leveraging to keep their business going.
Yeah, I'd say we're still the nicest house on the street, still the nicest house in the neighborhood. So we're definitely seeing some money come from overseas. Yeah, definitely a good point.
Yeah. If we look at some of these international emerging market ETFs, we can see that there's been a variety of different return streams from those. So India up about 11% so far this year. That's something that we've been big believers in. India's been taking a lot of the competition from China because of China's regulatory challenges. A lot of companies are going towards India.
Super volatile.
Yeah, extremely. China is, yeah. India's also been.
And we are in an election year also, so that's always kind of something that we can play off of as well. But I think we've kind of hit the key marks for this month in terms of where we are year to date and what we've seen this month. Jordan, you want to have any, Brandon, you have anything to weigh in on?
Yeah, I mean, I think one thing just to point out with the international ETF performance, I know, Bobby, this is something you always say and make the Instagram videos about, is diversification as lazy asset management. And just putting a little thought into it kind of goes a long way. As you can see, like the different year-to-date performances is just not necessarily looking at emerging markets or international, but kind of picking and choosing your battles as you look at, the return streams just from year to date and look a little bit more into each of them individually.
It's a good point. Like Sean said, we're in India because we think India is a better play. It's almost 4 points higher than the total international. So that's a big difference.
I think another couple things just to point out here, and one is, Bitcoin's up 61%. While that doesn't impact everyone on the page, we've said for a long time that Bitcoin's a pretty good indicator of people's willingness to take risk. You can almost look at it as a barometer of risk appetite. So when you see something up as much as Bitcoin, and it's really the whole crypto space, it's a big leap of faith. And it really is more the greed button than the fear button that people are hitting when they are going there. And obviously, there's always the people that are kind of cult driven on their belief in crypto. But
greed with speculation.
Yeah. Well, and that's what it is. So, normally when we see Bitcoin going up, we would say there's a market that has growing speculation. We'll talk a little bit more about that in another slide or two. We kind of have a discussion point there as well. I think the strength of the dollar is interesting. It's normally considered a safety asset in a sense when you're thinking about international currencies. Gold, which is hitting new highs, and the dollar are considered, places to safe stores of value, especially for international investors. The dollar is considered, the safety currency. So that's been very strong. I think that probably has more to do with the economy and maybe a little bit more with, again, as Bobby said, the nicest house on the block kind of thing, more than people just want to own dollars. And the last thing I'd probably point out is the Dow Jones being only up 6.4. And this just kind of points to when we lean more, the S&P is kind of the middle index. Then you've got the Dow, which is more old in value, the NASDAQ, which is more new and growthy. We lean in the new and growthy. And we're not leaning there because we don't think the Dow stuff is good. We just know that this has a better upside potential. And this is something, after COVID, everyone thought that we were going to go back to those big behemoth value investments. And that happened for about 6 to 12 months. And then it reversed course as new concepts like AI and the economy kept growing. And you look at the earnings growth that some of these large tech companies, let's call it less asset held down companies or less debt held down companies, really just start to outperform. And I think we're just seeing a continuation of that. It's worth just pointing to, some older investors always point to the Dow, and we always kind of point to the S&P or even the NASDAQ as other points to discuss. And I just think this is just something that we continue to see play out. And I think it's predictable.
Yeah.
Well, it's 30 versus 500 too. So it's also an interesting dynamic in terms of just law of large numbers.
Yeah, it's a 30 that they're slow to also replace. So it tends to, it doesn't have the same rule set that the S&P automatically replaces and puts in the higher market cap. The Dow is not only is the structure of it a little bit weird, but the fact that you have a committee that's basically deciding who goes in and out, and that committee is not inclined to want to, turn the whole thing over and put in probably the more appropriate names.
So Jordan, I'm going to just change direction before you jump onto this slide. Sean or Jordan, whoever's going to lead this one. Did you see the wrapped Cybertruck? They wrapped it in all white.
Yeah, it was NFL players, right?
It looks awesome.
Yeah, it actually looks really good. Like that, not so much. Kind of looks like an old microwave.
Take a shot at Elon's baby?
Maybe a little bit. Maybe a little bit ahead.
Tesla's
I think from the front, I think it looks good from the front. From the side, it looks weird. But nobody cares what I think, so let's move on.
Tesla so far this year, it's been on a bit of a roller coaster. Started the year at about $240 per share, went down to 140. Now it's back to 180. So there's been a lot of positive and negative news coming out about Tesla. First off, their earnings and revenue just haven't really been there so far this year. Their deliveries are down. The company is laying off their workers. So far, they've laid off 10%. It's possible they get up to like 20% of their workers. And that's hurting company morale a bit. People are coming into the office, not sure if they're going to be there the following week. So that's created a bit of an awkward environment at Tesla. But even with those things, there's continued optimism around the company. So even after Tesla released their Q1 earnings, and they missed on their earnings estimate, they missed on their revenue, the company was up 12% that day. So investors are really focusing on the positives around Tesla, at least after April, after that 45% decline. There's been a lot of optimism around cheaper vehicles. So the Model Y, the Model 3 coming in at those cheaper price points can really open up the inventory to more people in the middle class, and also that full self-driving technology that they're continuing to develop. That's just really exciting and very innovative. Is there anything else you guys want to add on Tesla? I know I've started to see some cyber trucks driving around Hoboken, New Providence, everywhere in Jersey, which I didn't expect to see them this early, but they seem to be starting to pop up.
They're getting out there. I think one of the storylines that you point to, some of the challenges that Tesla's had is there's been a lot of competition and there's been a lot of pressure around their pricing because of cheap EVs in other countries. And the big headline that came across was a potential tariff of 25 to 100% on EVs coming from China that might be coming down the pike. And, you know, Tesla's done amazing things. They've basically created a desirable electric car industry where there really wasn't one before them. But a lot of their success has also been somewhat government funded with EV reimbursements and credits for purchases. And when I hear the government doing something to directly help US EV makers, that does, you know, sound like a good storyline for the company, for the stock, for their sales directionally. So
if you want a foreign EV, now's the time to buy it before tariffs go up. Otherwise, you're more than likely going to not splurge and get the Tesla.
Yep.
not a bad time for their numbers. Let's talk about Roaring Kitty, Sean, your favorite.
Roaring Kitty. So meme stocks made a bit of a comeback in the last couple weeks. There was a buying frenzy on GameStop and AMC May 13th and 14th. Both of those companies were up about 3x over a couple day period. And Roaring Kitty, this is the guy from 3 years ago in 2021. He took to Wall Street Bets on Reddit and started making calls for people to start buying GameStop and AMC because there was such a high short interest on these stocks. So a lot of the hedge funds were betting against GameStop, and by buying it, he was forcing those hedge funds to cover their shorts, in turn really jumping the stock even more. So there's actually a good movie on Netflix about this called Dumb Money that goes through the 2021 saga of Roaring Kitty making those posts on those Wall Street Bets forums. And it's just interesting to see him make a comeback here 3 years later after being totally silent. It's looked like it's just going to crash back down. GameStop is almost back to where it was a month ago. So it wasn't a very long-lived rally for them, but it was just an interesting headline that we saw this month.
I've heard a couple people comment about this, and obviously, you know, when the stocks were going up 100% a day, this was something that kind of took over CNBC and some of the questions for the guests. And I thought, you know, the responses from the guests, obviously very few people are want to fight against this kind of mania. So people are careful with their words. But the one thing I'll say that a lot of people took as a positive of this is it shows that risk appetite. And that again kind of goes back to the crypto comment and the Bitcoin comment, that when you see people willing to buy stocks and push them up over 100% in a given day, it's probably not scared money. That's probably money where people are like, let me throw some bucks at this. And that kind of mentality just generally speaks to an investor who's willing to take a leap of faith a little bit more easily than in times like, you know, where the market's under a lot of stress. and suddenly, people are very hesitant before placing an investment. So it's more.
Did have a long period of time where there was some crazy easy money if you started to look in different areas, which ended up getting swept off the table really quickly. So that's one of the shortcomings of trying to follow a lot of these trends. But one of the things that we talk about, even just from a outside of the investment standpoint, and when we go into a broader, more planning conversation, is the people who are more of a want mindset than a need mindset. And that wants versus needs and the immediacy of the internet and the speed of data and the speed of being able to do something a little bit more risky, like something like this. It also just talks to the general sentiment in terms of the psychology of certain people in the market.
Yep.
So I don't know, I don't know how much credence you put toward that, theory, but that's where I'm leaving that one.
Yeah. And it hasn't been only GME and AMC. Actually, a lot of the other companies with huge short interests have been getting some traction in just this last week, like Spirit Airlines, Beyond Meat, SunPower, Plug Power, just a few of those that have seen a lot of volatility so far this week. It's not something that we like to target in people's portfolios, given the volatility around it, but it's just something interesting that we had seen this week, this month.
Yeah, so I big slide here. Yeah, but basically what this table is showing is the historical S&P performance following the first Fed rate cut. So I can break it down a little bit easier. So the first column is
Brandon, a lot of numbers here. So just kind of give a quick overview of each column.
Yep.
So that this way, the watcher and listener could follow real quick.
Yeah. So the first column is just the date of the, last Fed rate hike. And then the second one is the number of days between the last hike and then the first rate cut. As of right now, we're at about 300 days. The last rate hike was July 26, 2023. And then the last two columns are just the 6 months performance following that first rate cut and, the 12 months performance too. I think there's really a few key takeaways here. One of them is just the reasoning behind why we see some of these numbers. I highlighted the largest gains in both of those columns, 6 months and 12 months, and then also the largest declines. You can kind of see from the 6 and 12 months that most of these numbers are positive returns. And the reason for that is, the Fed rate hikes, they're really to put a restrictive nature on the economy. And then when they finally do that rate cut, it's really a relief valve that they're trying to pull so then they can start to, stimulate the economy again. And, we usually see, good times ahead from that and positive performance. So that's kind of one of the, things to take into consideration of why there's, positive performance there. And also, if you look at, two of the major down years, 2000 and 2006, those are really because of financial crises. Not necessarily because of, the Fed's actions in a sense, in terms of just the interest rates. So, one of the things also that as of right now is it's a highly anticipated, Fed cut. It was supposed to happen, a lot of talks in the beginning of the year about June. Right now it's really been pushed back to September to see what happens. So it would be about, 400 days by then. And I think it's really anticipated. So that's one thing to take into consideration. It's not as big a surprise as them going into a meeting and, taking action. And, one of the things Jordan and I were talking about before this is, during the Fed meetings, what are we really looking for? It's not so much whether they're going to cut or hold, that's kind of anticipated and everyone kind of understands what would happen during those times. But really what we're looking for is if there's any sense that they're going to hike rates one more time, what would that effect be? And the concern off of that more so than, holding steady for a few more months.
Yep. Well said. I think it's a moving target trying to guess when the Fed's going to end up cutting rates. Like Brandon said, it started with 6 expected rate cuts in 2024. Then it shifted down to 3 expected rate cuts. Now it's between 0 and 2. So it's really just an observation game, continuing to look at where inflation's coming at, how the unemployment numbers are looking.
And you just said it right there, Sean, right? It's about us observing and understanding what's going on around us. It's not about us playing the guessing game or trying to use our crystal ball to figure out where the next bet's going to be. I think we just need to be logical about this.
Yeah.
And, I think logic will point us in a direction of assuming that given the current environment, we're not going to see any rate increases. But to your point, we kind of know what's going to happen if it doesn't get raised, lowered, or if it does get lowered. Let's see where it goes.
Yep.
One interesting thing to, as you look at the number of days until the first rate cut, we don't have the average number there, but, just a quick eyeball, so it's probably, close to 200. Like you said, Brandon, we're at about 300 days. Doesn't seem like they're going to be cutting in the next 30 days. That would really put only two other periods in 1969 at 405 and in 1981 at 874 days. Those would be the only times where they stopped hiking and there were longer periods before they cut rates. So, if you kind of put that into sense, if they do cut this year, the number is likely to be close to that 400 or 400 and change. It is unlikely to be 874. I think to your point, if right now the Fed came out and said we're more like 874 than 400 and change, that would have a big impact on the market. Or if they even said we might raise one more time, in which case the clock gets started again. So that's this is a great table. I think it just kind of shows a little bit. Let's not get too caught up on the minutia and things like that. A rate cut is likely in the future, and good returns are likely to follow after that, as long as it doesn't get interrupted by some unexpected event. So that's kind of our game plan, and that's why we say the word mid-cycle when we talk about where the market is when we just feel it out.
Yep.
All right, everyone. So now to the main event. If you've accumulated any wealth, if you have anybody that you care about, if you have any situations where there's, you have elder parents that are getting older, you're playing in the sandwich generation, so to speak. Special needs situations where you have children or spouses or special needs in the family. Deana's the go-to person. She's currently an attorney with the Wacks Law Group. She runs her own practice. She assists the clients by crafting and implementing personalized estate plans, simple wills, complex trusts, everything in between. And I just pretty much said the bottom one in my opening. So please welcome Deana.
Thank you, guys. Thank you for having me, first of all. And I love that little introduction presentation. It's so helpful for people who don't follow the market and don't have an idea of how this all works. So great job, guys.
Sean, this is the conversation. Yes.
So what I'd love to kind of know from you guys on the advisor side, what is the most interesting part of all of this? I have a lot of times where clients come in, potential clients come in and want to know why, right? Why do we need an estate plan? Given the federal tax exemption right now, even the most wealthy among us don't really have a tax concern yet, right? New Jersey's gotten rid of estate taxes. So when you guys sit down and meet with clients or when you have conversations with colleagues, what is the most interesting piece of estate planning? What do you guys want me to focus on in terms of knowledge that I can bring to the table for your clients?
So I think it's interesting because it really is based upon the age group and the person that we're speaking with, right? So if we're talking to somebody who's younger, we're going to focus less on, like you said, zero in New Jersey. Exemption rates are high in federal. So unless you have over $25 million in net worth, you're probably going, well, what am I doing this for? And like I said, younger people probably talking more about guardianship of kids, who's taking care of the money if both parents end up going someplace. If we're talking about more middle-aged people, we're probably having the conversation of when your kid turns 18, if something were to happen to them, how do you get the medical information that's required? Since they're 18, they're an adult, and you're not privy to that information anymore, right? And then if you're older, you're probably talking a little bit more about what's the general plan of if something happens to you, and we use abducted by aliens because we don't like to kill anyone off, who gets what? Or do you want the state to decide? Right.
Yeah.
So I think that's a really good place to play around in this conversation, is that most people are going to be, until 2025 and everything sunsets back, right? From now to then, what is the general population looking at in terms of the reason why? And then what happens after the law sunset, and what are you guys anticipating or planning toward as you start to have conversations with clients, with that being the the timeline, so to speak.
Awesome. So I'm going to just jump right in it, right? When we talk about an estate plan, regardless of which spectrum you're on for planning purposes, estate planning really needs to cover 2 time periods. It needs to cover the period of time when you're alive, but there may be a potential incapacity, either short-term or more longer term, like a surgery, operation, accident, on the short-term spectrum, or on the more long-term, a disease, a disability, cognitive impairment. You need things in place to protect against that piece. And a lot of times I have clients come in and say, well, I have a spouse, right? They'll make the decisions for me. Or I'm a parent, I can make the decision for my kid. Unfortunately, that's not true in the law. The law doesn't care who you're related to or who you're married to. There's nobody else in the world that can sign your name, manage your personal affairs, or make medical decisions for you if you do not designate that person yourself. So we go back to the first reason, right? Which is you need to have these documents in place so that you can control who makes the decisions for you, rather than leaving it up to a judge who's going to be called in the middle of the night if there's a surgery and something needs to be decided game time. And the second thing is that you really need to have in place your wishes to guide those people that you're choosing. So during lifetime, we talk about having a power of attorney. That allows someone to make financial, legal, and personal decisions for you. File your tax returns, write checks, move money, make investment decisions, talk to advisors, accountants,
So Dina, let's use Bobby and Brooke, right? Let's use an actual case scenario where, and I'm just using my name and my wife's name just to create something, so this way people can kind of envision what the story would look like. And let's say all the money that we had, most of the money that we had, operating accounts and stuff, weren't really joint. They were in Brooke's name, and something happens to Brooke. I don't know. You build the scenario. You're going to do a better job at it than I am. But why don't we use a little visualization storytelling for this?
Yeah, I hate to use real people for the same reason you guys use abducted by aliens, so do we. But since you put yourself out there, Bobby, I will run with it. So perfect example.
How about Brenda and Eddie? Because they were the
Brenda and Eddie, they were the most popular steadies. And
yeah.
Okay, so let's just say that Brenda and Eddie have joint accounts, right? They have a whole bunch of joint accounts, and then they have their own retirement accounts. And then Brenda's got some money that her parents left that she's got in her own brokerage accounts. They have accounts for their kids, and they own 2 properties. One is a vacation home and one is their primary residence. Something happens to Brenda temporarily, right? She's in an accident, she's in the ICU. We have hopes that she's going to recover, but right now, she has no idea what's going on. She's hooked up to machines, and for the next couple of weeks and months, she's going to be out of commission. And let's just say, for purposes of our scenarios, it's March 20th, right? So tax day is right around the corner. Brenda and Eddie, like most of us, haven't done their taxes in advance, so they're still working with their accountant to get everything filed. The first issue we have here is that Eddie cannot sign Brenda's name for the tax return, right? So if this return has to be signed by both of them, if decisions have to be made by both of them, nobody can sign Brenda's name. She doesn't have a power of attorney in place. She doesn't have anything in place to allow Eddie to do that. So they're going to have to file extension. Great, no big deal. Let's also say that it's kind of touch and go in the beginning. So they're not sure how Brenda's going to do. Maybe she's going to make it, maybe she's not. But she's got no beneficiaries on any of her assets because everything she just assumed was going to pass to her husband, right? So The first issue is we can't update her beneficiary designations because she's got no powers of attorney. So minor kids, spouse, whatever the case may be, where she wants her money to go, nobody can get in there and update those documents. If she needed cash quickly and they didn't have a lot of assets to pull from and she needed a home equity line to care for her, to pay for her treatment, nobody can do that for her house because it's mortgaged by both people, it's owned by both people, and without a document in place to allow somebody to sign for her, her husband, despite the fact that they have a lot of joint assets and they own these properties jointly, cannot manage anything on her behalf without her signature. And the
So
same,
tons of limitations.
go ahead, I'm sorry.
No, so you're limited, even though you're a married couple, there are limitations in the law and the institutions that control the access to money are going to require more than what you're able to provide.
Yeah, and recently, you know, the past year, financial institutions have been getting really, really meticulous about who does what and making sure the proper documentation's in place. So a power of attorney on the most basic level allows somebody that you trust to be able to manage these affairs without having to go to court and get legal authorization through a guardianship, which is really, nobody wants to do that.
So Deana, what about access to even information from a health standpoint? I know 2005, if you have not done updated your estate planning since 2005, you're going to be in a little bit in trouble with this. But what about the spouse that needs to talk to the doctor and needs to have access to medical information? How does that work?
So it can be really scary, you know, most of the time informally, if, you know, you're confirmed to be a spouse, you're allowed to go into the room, you're allowed to kind of informally talk to nurses and get updates generally with information. But the problem becomes, A, hospitals and doctors are getting really anxious and litigation adverse. So they want to make sure they're following the rules to the T. And B, if decisions have to be made. You know, straight information, if you can confirm you're the spouse, maybe you'll be able to speak to the doctors. But what happens if Brenda's got a health event and somebody needs to decide for her, are we going to go this avenue? We're going to go this avenue. If she doesn't have a healthcare proxy in place, there's nobody to make that decision for her. And if she's incapacitated, even temporarily, she can't provide guidance to the medical professionals. So it really puts her in a difficult position, and it puts the doctors in a really difficult position where you basically have to go to court to get a special medical guardian appointed to make decisions on behalf of Brenda. So, you know, nobody wants that. First of all, nobody wants the judge to be involved in your healthcare and for this to be broadcast before a court, right? And you also want to be sure that you have your wishes kind of memorialized, right? Most of us don't talk to our spouses and our children and our other loved ones about what we'd want to happen in these medical situations. So it may be that Brenda and Eddie had never had a conversation about what Brenda's wishes would be in the event of a health emergency. So having the documents in place not only gives immediate authority so that there's no delay, no judge, no court involved in making your medical decisions, but it also provides a roadmap from the people that you love to make those decisions. And it lifts a burden, especially if you're putting kids or somebody other than your spouse in that position. They don't have to feel like they're making the decision, especially if it's a hard decision to make, right? They don't have to feel like, oh, I pulled the plug on mom or dad or whatever the case may be. They can say, I followed mom's wishes. I followed dad's wishes because they were written, it was clear, it was easy to follow, and I had the guidance. And by the way, this is really important for adult children that are going off to college, right? If you have an 18-year-old, they are a legal adult in the eyes of the law. So we had a situation where parents got a call in the middle of the night, some roommate, right, just happened to find their friend's phone, called the parents and said, so-and-so's going to the hospital. Click. That was the end of the call. These parents are a 4-hour plane ride away, right? They can't get a hold of anyone. They call all the hospitals. Nobody's willing to give them information because this kid's an adult. They get on a red eye, they fly over there, get to the hospital. Turns out the kid just had drank too much and went to the hospital just to kind of get brought back to baseline. But they had no way of knowing that, right? And a simple healthcare proxy for your adult child would enable you to speak to the doctors, get information, and be there for them to help make decisions when they need it.
Yeah. I think one of the other things that that becomes an important topic is inheritances and the importance of not commingling inheritances into the marriage, and how to prevent that, or things to think about around that. You mind touching on that a little bit?
Yeah. For all of us who have been married, we can remember back to those early days. You're engaged, the sun rises and sets with this person. Nothing is ever going to go wrong, right? This is just going to be the love story of a lifetime. And hopefully that's the way it is, but
Not Brenda and Eddie.
not Brenda and Eddie, right? They deep pile carpets were a big problem for them. Anyway, so there's a couple things you could do beforehand, which people are not always interested in doing, right? You can have a prenuptial agreement, you can have a waiver of elective share, a whole bunch of legal documents, but sometimes that's a hard sell, right? So absent, as a parent, absent keeping the money in trust indefinitely for your child, which may or may not be a good idea, there's some really easy tools that we can use in New Jersey to make sure that we can protect those assets as best as possible from an eventual divorce. And the first is keep those assets separate. If you have an inheritance from a parent or another family loved one, make sure you keep it in an account that's only in your name. Don't put your spouse's name on it. Don't commingle it with other funds. Keep it just in your name and make sure that's only inheritance funds that are in that account. The second part is how you manage that money, right? So you can't use that money for things that would benefit the marriage on a consistent basis. Don't make that the account that you're paying your mortgage payments for. Don't make that the account you're paying car payments for, and so on and so forth. Make sure that if you're going to use that for family purposes, it's on a one-off situation where there's no development of an expectation that those funds are going to be used to benefit the marriage.
So what if you randomly took, like, because we are in a population right now where you have a lot of wealth being transferred from one generation to the next.
Yeah.
Let's say there's an inheritance and somebody starts to not pay their mortgage, but every couple months they might throw 5,000 or 10,000 into the joint account just to help to fund it. Might be various amounts, might be the same amount, but what would be a problem with that? Would that be a solution?
It's everything with regards to divorce is based upon the facts and circumstances and interpretation by the judge, right? So it's going to be a matter of, did your spouse expect and rely on this money as a continuous source of income to help alleviate family expenses? If the answer to that is yes, it could put you in trouble. So, what we try and advise our clients to do is really just use that as an excess fund, right? And shift costs from other places to free up capital that would not have to be used from the investment. If you're going to take a vacation, a major vacation once a year, could you pull money out of that? Sure, you could. And maybe instead of saving money from your joint accounts for that vacation, you use the inheritance and you use the joint account money for more consistent stuff. If you need the money, for sure, you need to use it from the inheritance, right? I'm not saying don't use it so that you're ending up in a financial hardship, but just be smart about what the expectation may be on your spouse's side. There's not really much, there's people talk about postnuptial agreements all the time. There's not really much that's going to do in the divorce setting. But being smart about how you use the funds is the first line of defense for sure. And that may roll us into another good topic, but the second piece to that is making sure that you have the right beneficiary designations on that account, right? And making sure that you're going to designate where that inheritance money is going to go, so that in the event of an untimely death, you designate the inheritance money where it's supposed to go long term. Does that go to children? Does that go to siblings? Does it go somewhere else rather than just to the default spouse?
And would you consider that to be a good reason as to why people who will be transferring any wealth should consider the estate planning process, not only for power of attorney, not only for healthcare directive, guardianship for the kids under, underage, but also, maybe trust planning around this. So it goes from your child to your child's children, as opposed to your child and then their spouse, and then if they get remarried, and then it gets lost after that.
Yeah.
You know, so it becomes scary. The choose your own adventure becomes really scary once that happens, and you want the best for everyone involved, but sometimes it turns out to not be so pretty.
Yeah, and you know what? The best way to avoid the ugly situations on all ends of the spectrum is to plan, to have a good plan in place and to make sure everybody's aware of the general plan so that there's no unrealistic expectations or things that may have gone a different way than what you were anticipating. Trusts in New Jersey are really great because we don't need them, right? As a basic estate planning vehicle, we're lucky in all the other respects, maybe not so much, but we're an easy state to pass away in and continue with an estate administration. So we don't need revocable living trusts like a lot of other states like New York and Massachusetts and Florida, even Pennsylvania. But that frees up the flexibility to use these trusts in various ways and to make sure that we can have them work for us to effectuate our intent and to make sure that the assets we're leaving go to the right people at the right times and in the right format.
So I do have a question here about a prenuptial agreement. Will prenuptial agreements help in this case?
Yeah, a well-drafted prenuptial agreement will for sure help in this case. So for a lot of my estate planning clients, they'll have a family law attorney draft the prenuptial, and then we'll review it to make sure that it's compliant on the estate side and the distribution side. Usually with the prenuptial, we recommend also signing a contemporaneous waiver of an elective share, because New Jersey's got a weird rule that you cannot disinherit a spouse. So there's some argument about how a prenuptial will play into that piece of it. So
Those nuances.
Yeah, there's nuances. You have both parties, both attorneys work together. Prenuptial is still the gold standard always. But you know, there's again some ways to make sure that you have the prenuptial, now you're getting to living and to accumulation of assets. You want to make sure that your actual administration of what your financial plan looked like still mirrors what the prenuptial agreement says and what your intent is.
So we have another question here that says, you brought up sunset, the sunset agreement, the sunsetting in 2025. They want you to explain what that means.
Yep. So right now, we have a federal estate and gift tax exemption amount of $13.61 million per person. That means that during your lifetime or after death, each individual can give away to anybody in the world $13.61 million and not pay a single dollar of federal estate tax. That law, it indexed for inflation every year, so it'll go up a little bit more 2025. At the end of 2025, that law sunsets and it goes back to the pre-law rates, which is about 5 million indexed for inflation. If the government doesn't act beforehand, right? The government can change the law, put a new law in place, or make any kind of modification. So this gives us a really great opportunity to take advantage of that high exemption. Because if you do gifting now, if you do trust structures now that are put in place the right way, you can take advantage of that 13.61 million today and not worry that if it goes back down to 7 million in 2026, that you're going to be hit with another estate tax. So if you have a high estate, high net worth estate, if you anticipate having a high net worth estate, if you have real estate as part of that or business interests or other assets that we can effectively plan with, now's a really great time to do that. And what I always like to tell people is it's not an all or nothing. You do not have to give away all $13.61 million today to make this work for your plan, right? You can do piecemeal planning to take advantage of some gifting. Ideally, it would be with assets that have a low cost basis now that are going to appreciate and accumulate later on. And that can help you offset any potential future increases in your net worth.
So I have somebody that asked, does that, and I'll let you answer this because I could go in not only detail, but I'll start talking about education planning and things like that. I'd rather you do it. So does this include annual gifting is the question.
It does include annual gifting, however, so the annual gift exemption amount is 17,000 right now. 17,000, or did it go up to 18,000? I think it's 17. And what that means is that if you don't, it's actually 18,000 this year, I apologize. If you make a gift of under $18,000 per person, you do not have to report it. So the gift amount that we had said, the federal gift exemption, is the total number, right? If you make a gift of $15,000 to one person in 1 year, you don't even have to tell the government about that. They don't care, right? You can just give it away. It doesn't get reported. It doesn't remove it from that 13.61 million. If you make a gift of 20,000 though, you then have to report it, and that excess gets removed from that 13.61. Spouses can duplicate the amount. So if you're planning for grandchildren, if you're planning for children or more distant relatives or friends or family, you can use this, especially if your spouse is gonna agree to the gift and consent to the gift, you can double that, right? And that's really great for grandchildren, for funding college, for funding further education, higher education, down payment to purchase a house, to start a business. You don't even have to tell the government that you gave that gift, so it doesn't eat away at your 13.61 million.
Jordan, it looked like you were going to ask something, so I'll let you jump in.
Well, I'm going to change gears though. So I don't want to, I think the expiration of that 2025 exemption is a big deal. I think, that's something that if you are even sniffing those levels, you should have already had conversations, or you need to have a conversation before that expiration, so you know what you're walking into, you know what tools you can put in place. I think you did a great job highlighting that. For those that's not that applicable to, the one thing that I think we can all agree on this call is I've yet to meet someone that updates their will too frequently or updates their trusts too frequently. I don't think I've ever run into someone where it's like, guys, you don't need to go to your state attorney again. Normally we see it on the other side where people haven't updated these things on a frequent program. And so I'm wondering if you could help some of our listeners understand what a good maintenance program is for wills, trusts, estate planning. What's the right amount of times to see the doctor? And when do you go see the doctor when, something comes up?
I love that you bring this up, because this is my biggest struggle as an estate planning attorney, is making sure that people come back and update it regularly, because life changes. So I'm in the process of working on a maintenance plan that will help people kind of stay more regular. But my rule of thumb right now is every 18 months, you should have a quick call with your estate planning attorney. So I tell my clients, as soon as they sign their documents, put a tickler in your calendar from 18 months for now, so that you can remember to just sit down and touch base with me. Simple 10-minute call. Hey, everything's the same. No problem. Let's review the people that you've chosen to do these tasks. Still good? Great. Let's review the ages. Your kids are a little bit older now. Let's talk about if you think that it's still an appropriate plan to distribute at these ages. And then we can talk about any taxes on my end, on the federal law, on the state law, anything that would impact their overall estate plan that we may need to touch on. The purchase of new properties, the investment in new businesses, especially if those businesses and properties cross state lines. It's important to make sure that you advise your attorney about that and you come back and sit down and review it. Another big thing, which is not so relevant for your clients, because I know you guys do this firsthand regularly, is beneficiary designations. If you've opened up a new account within the past 18 months, having that quick call with me is going to trigger your memory to say, hey, let's look at your beneficiary designations. Do they still comport with what your plan says? Have you opened up any new accounts, new life insurance, new 401k, new job, anything that we need to review and get in place? Absent that 18-month mark, it's really important to remember big milestones. Your attorneys don't need to be the first people you call, but we should be like 4 or 5 on the list after the birth of a new child, death of a family member, any major change in the health of you or your loved ones, any major change in the financial situation of you or your loved ones. Always a good time to say, major change in life, let's sit down and review our options and see if we need to tweak anything.
So I would love for you to add just a little bit on portability, what that means, and how that relates to also if those rates do come down and stay in that $5 million range, what happens with portability after explaining it?
So portability is something that only applies for federal law, which is important to know in the event that New Jersey brings back the estate tax. We still have an inheritance tax, which I'll touch on in a minute, but we don't have an estate tax here in New Jersey right now. A couple of other states do. On the federal level, however, for that 13.61, which is going to come back down to 5 million index for inflation, portability means that whatever amount of that 13.61 the first spouse to die has not used, if the right things are done at the first spouse's death, the second spouse can take it, can bring it over to their exemption. So now, effectively, the second spouse gets 27.22 million per collective to distribute to whoever they want, any of their heirs.
Can that be done after death, or does it have to be done planning prior to death?
It can be done after death, right? So you'd have to file within 9 months of death the right tax forms with the federal government to claim that exemption. So even if the first spouse does not have a taxable estate, even if combined, both spouses don't have that amount yet, I always advise clients that if you're close, sort of close, or you are in the accumulation phase still, and your estate's going to keep climbing, file the right forms that need to be done on the federal level, the 706, to get that portability election made so that at the second spouse's death, you have the option. If you don't lose it, you're not going to be penalized for claiming the portability exemption, right? But if you don't do it within the right amount of time and your estate grows or the law comes down, right now, rather than 5 million index for inflation, maybe we're at 3 million, which I don't think is going to happen, but for the purposes of our example, 3 million, if you never claim the portability exemption and your estate is 4 million, now you're going to be your kids are going to be taxed at $1 million over that $3 million threshold at your death. Whereas if you had made the simple election at the first spouse's death, it would all pass tax-free. So can be done. You can think about it and talk about it and plan for it pre-death. We certainly plan for it in our documents as an optional trust that we built in that can be done and established post-death. But you need to sit down with your estate planning attorney and your financial advisors, certainly a month or two after death, to make sure that whatever elections and whatever trusts need to be established can be done so within the right amount of time.
Now, I mean, this just really scratches the surface because there is so much to go into from the estate planning conversation. We still haven't even talked about special needs situations. We haven't spoken about Medicare or Medicaid. We haven't spoken about anything that goes beyond just the general basics of estate planning. So you can only imagine that if your situation is a little bit more complex, if you should be talking to somebody on something that's general, then you should definitely be talking to somebody if your situation is a little more complex. So when you get into owning your own business, shares of business, what do you do? Because there are certain things that you want to make sure that you take into consideration. One of them might be step up in basis, which I don't even think that this is the place to explain what step up in basis is in full detail, but it's basically if you paid this for it and it's worth this today, if you were to sell it, you pay on the taxes. If you die, the government allows you to now move your basis from here to here on the date of death. Well, if you move it into trust, you don't get that step up in basis. So there's a lot of like moving mechanical things that that are definitely specific to everyone's estate plan. It's very similar to to what we say from from your financial plan. Everyone's financial plan is a little bit different. Some people want to spend a little bit more, somebody want to save a little more, some people want to give to the kids, some people want to bounce their last check. Well, estate planning really helps to make sure that all of those mechanisms go into place. Given certain situations, life situations, or abductions by aliens, you never know what's going to happen.
Yeah, and New Jersey has an inheritance tax as well. And the right planning, even if you have no kids, right? Even if you're not overly concerned what's going to happen to your kids because you don't have any, you have a small estate. New Jersey has an inheritance tax that is assessed, doesn't matter how much money you leave to somebody, right? So that 13.61 million doesn't matter. You can leave $1,000 to somebody. And in New Jersey, depending on what the relationship is, if they're not bloodline descendants, parents, children, grandchildren, the estate is going to be taxed on that. So there's some planning that we can use to prevent that or to minimize that, certainly make it easier for the executor to handle later on. And, take advantage of these planning opportunities that are coming up as the government's kind of cracking down, right? Capital gains is a huge one. Secure Act with regards to retirement accounts. That's another big one that is going to impact beneficiaries for a long time. There's tools that we can use to make sure that we're maximizing the amount of tax savings that we can pass on and maximizing the amount of administrative headaches that are there. So I guess my last.
Yeah, I mean, there's even if your life insurance is done wrong, it goes back into your estate as a calculation cost your estate.
Right.
So I mean, we don't like to harp on the things that happen when you die, right? We're all about planning to live, but part of planning is taking the failure away where we can. And the biggest, one of the biggest failures is if something happens to you, spouse, somebody you love, things are dispersed in a way that you would have wanted it to be done and not in the way that the state has elected. Nor do people typically say, hey, listen, when I die, I hope it all goes to taxes. I really hope the government, the IRS takes all my money and the federal and the state government take all my money because they deserve it. They earned it. They should get it. Very seldom, if ever, will you ever hear that.
Or assisted livings, nursing homes, or home health aides. You don't have to just be worried about taxes. We're living a lot longer these days, but we're not necessarily living healthier. So thinking about how the assets that you've accumulated are going to, of course, fund your care later on, but also allow to pass to your beneficiaries is a really big deal. Planning for long-term care is a huge component of what we do. And I think it's so necessary for those of us, almost all of us, who've worked so hard to accumulate these assets, right? We don't want it to go to a for-profit nursing home for what, right? Let's find ways that we can protect it while still getting the same level of care.
Yeah, I'm just going to add one last sentiment to really drive that nail right down. Is I think we for the most part we live our lives hoping that our legacy is remembered in some regard. Our kids love us, our spouse loves us, they tell stories about us into generations, maybe hang our painting and portrait above the fireplace, and that's my great grandmother and grandfather. But at the end of the day, if you don't do all this planning, the amount of work that goes on to the executor of the estate and the pain and suffering of having to deal with the difficulties of selling things out, the having to write checks for things that wouldn't have had to have been written for, all of a sudden it changes the sentiment when you're gone. And that's the one thing you don't want to do is change the sentiment based around putting financial stress on your family, and as well as the stress of having lost somebody. So, where if you can plan around the financial stuff, doing the right estate planning, then they can spend the appropriate time mourning you and doing the things that are more natural and less chaotic and, emergency room type of activities where you're running to get one thing done over here, another thing done over here, another thing done over here.
Yeah. We have a saying in Greece when someone passes away, may your memory always be eternal and always a blessing. And that's really what you want to leave your family with, right? Something positive to remember. You don't want that headache at the final days. You don't want that headache afterwards where things are a mess and you can't focus on mourning and remembering the person. And you have to focus on cleaning up the issues that were left and dealing with these governmental entities, which just make life so difficult, clean it up.
And you yell hopa and you throw the shot glass on the ground.
Right, that's it.
Any last remarks, because we're hitting the hour mark. I just want to be conscious of time. Deana, where can we find you, but is there anything that you'd like to leave with the group before we part ways?
So, because my name is exceedingly long and difficult, I will, I can't even spell it for you on the phone. I'll put it in the chat so you guys can find my email.
We're
Anyone,
gonna put it in the notes below.
yeah, anyone in the team can put you in touch with me. If you're coming from Bobby and Jordan and crew, you're gonna get a free consultation. So you can sit down with me, grab me for 30 minutes, and we can just talk through what's going on and how estate planning might benefit you, or updating your estate plan might benefit you. It's not scary.
Deana, are you okay if we send out this, because we send out the recording? With the recording, do you want us to also offer that to anybody who?
Yeah, of course. Anyone coming from you guys, 30-minute consultation free, no charge. Let's sit down and see what we can do for you guys. I do my plans for the most part on a flat fee basis, so you'll know what you're looking at when we sit down and talk
That's
about getting your documents in place. It's way cheaper, easier, and more effective to do the planning now, pre-crisis. So sit down with me or another estate planning attorney that is competent and knows what they're doing, and just knock it out, get it out of the way, and then put it in a drawer and forget about it until 18 months from now when you got to pick up the call and make a reminder phone call.
Deana, you've been great. Guys, you good? We good?
We're good. Deana, thank you, girl.
Thank you, Deana. Very informative.